Infosys started the earnings season in style, clearly outperforming its peers by a large margin with much superior execution, stability in margin, resonating optimism on demand environment, return of pricing power, and moderation in supply side challenges in terms of skilled manpower availability down the road. While attrition remained high, it did not stand in the way of a stellar execution. Now, 2022 looks like another strong year from a technology demand standpoint, and Infosys certainly looks to be in a pole position. We believe the stock should now command a valuation multiple at a premium to its peer and its closest rival, TCS. Revenue for the quarter stood at $4,250 million, a 6.3% sequential growth in reported and 7% growth in constant currency. The year-on-year growth of 21.5% in CC terms was the best performance seen in the last 11 years. Growth was broad-based across North America and Europe, which make up for 87% of revenue share, as well as India and the rest of the world. Even excluding India, we saw a sharp spurt in the quarter and growth was extremely strong. All 7 key industry verticals reported sequential as well as year-on-year growth. Manufacturing was especially strong thanks to ramp-up of the large deal from Daimler. The strong execution, which was clearly a positive surprise, has prompted the management to significantly revise upward the full-year revenue guidance for FY22. The earlier guidance was 16.5 to 17.5%, which has now been hiked to 19.5 to 20% growth in constant currency. Margin guidance, however, was retained in the band of 22 to 24%, although the company has so far delivered close to the higher end. The share of digital in total revenue grew to 58.5% from 56% in the previous quarter, and it also showed a YoY growth of over 42% in constant currency. Infy is witnessing strong demand from cloud adoption and digital transformation of programs of various enterprises. Now, compensation hike was a negative 80 basis points drag on the margins, and that was necessitated by the talent crunch. Decline in utilization on aggressive hiring also pulled down margins by 40 basis points. However, thanks to cost optimization, lower sales and marketing expenses, and 20 basis points benefit from cross-currency, the overall sequential margin decline was restricted to only 10 basis points. The good news here is that margins could see an uptick on stable offshore on-site mix, better utilization, higher deployment of freshers, and above all, return of pricing power. Management alluded to better pricing negotiations riding on the value addition that digital is offering to a whole host of clients. Client metrics remain strong, with the company adding clients in the $100 million, $50 million, $10 million, and $1 million bucket. The overall share of top 5, top 10, and top 25 clients in total revenue has improved, indicating market share gains due to better client mining and vendor consolidation. Hiring continues to reflect the optimism on growth with net addition of 12,450 during the quarter. The company plans to hire 55,000 freshers in the coming year. The commentary on demand environment was positive as it gets, and the company won 25 large deals in the above $50 million bracket in the quarter gone by. Now on to the negatives. Given the tight labor market and severe shortage of skilled technical talent, the company saw a steep spike in attrition from 20.1% to 25.5%. The heartening news here is that the attribution on a quarterly annualized basis is stabilizing. With significant hiring and training of freshers who will come into active billing after a few quarters, the company expects stability to return on the supply front. Thanks to robust demand and shortage of skill set and restricted mobility due to COVID-19, subcontracting cost was high. This too could ease as talent crunch gets gradually addressed, and this should be a kicker for margins going forward. So why should you own the stock of Infosys? We draw comfort from 2 factors. First, the talent shortage that was impacting margins, which should gradually ease thanks to aggressive fresher hiring and reskilling. Second, the supply crunch, which is being recognized by the clients, along with the value that digital brings to their enterprise, and this should result in better pricing going forward. And finally, the demand environment, which remains robust, and the industry, which is still in the early days of a multi-year growth cycle. So a leader like Infosys, whose capability matches the requirements of the industry, is definitely in a sweet spot. And in a year where markets are staring at headwinds that could possibly weaken the currency as well, IT looks like a good theme to bet on, and what better way to play the multi-year growth theme than Infosys, which we feel will soon command a premium multiple to bellwether TCS at 30.5x FY23 estimated earnings.